Most traders analyze swings the same way. They watch the market move from a low to a high, or from a high to a low, and then they try to figure out where support or resistance might appear next. But there's one piece of information that most traders completely overlook during those swings. They focus on the candles themselves, but they rarely analyze how trading activity was distributed during the move. Because when price travels from one level to another, thousands of trades occur along the way. Some price levels attract heavy participation, other prices barely see any activity at all, and that difference can tell you a lot about whether the move was strong, weak, or likely to reverse. The problem is that most volume tools show you only one static profile for the entire chart. That means you can't see what actually happened inside each swing. You just see a large summary of volume, which hides the details of how the market behaved during each move. But the tool we're looking at in this video solves that problem in a very interesting way. Instead of creating one profile for the entire chart, it builds a separate volume profile for each individual swing, allowing you to see exactly where traders were most active during that leg of the move. To demonstrate this tool, open TradingView and load any chart you want. I'm using the 15-minute time frame here, but this approach works on forex pairs, crypto, stocks, or commodities. Once the tool is loaded, you'll notice something very different from a normal volume profile. Instead of one large histogram on the side of the chart, you'll see multiple profiles attached directly to individual swings. Each time the market moves from a swing low to a swing high, or from a swing high to a swing low, a new profile appears for that movement. These profiles show how volume was distributed during that specific swing. Right away, you can start seeing which prices attracted heavy participation and which ones were skipped quickly. This gives you a much clearer view of how the market actually traded during that move. Now look closely at one of the completed swing profiles on the chart. You'll notice that the profile contains horizontal bars that represent the amount of volume traded at each price level during that swing. Some levels will have very thick bars, while others are extremely thin. The thick levels are where the majority of trading activity occurred. These are areas where buyers and sellers were both active and where the market spent time agreeing on price. The thin levels are where price moved quickly with little participation. Those areas often behave differently when price returns later. Price tends to slow down or react near high volume zones because traders previously committed orders there. Low volume areas, on the other hand, tend to act like empty space where price can move quickly again. That's why understanding the internal structure of a swing can give you valuable context for future price behavior. Inside each swing profile, you'll usually see a highlighted level. This is the point of control, often called the POC. The point of control is the price level where the most volume was traded during that swing. In other words, it represents the price where the majority of traders agreed on value. When price returns to this level later, it often reacts because that area previously attracted the most participation. You may also notice lines surrounding the POC that represent the value area high and value area low. These lines define the range where the majority of the swing's volume occurred. When price trades inside this value area, it usually indicates balance. When price breaks outside of it, it can signal expansion or continuation. Another thing you may notice is how the distribution of volume changes from swing to swing. Some profiles look wide and balanced. Others look narrow and concentrated. A wide profile often indicates that the market traded broadly during that swing, meaning buyers and sellers were negotiating price. A narrow profile usually means the market moved quickly with strong directional pressure. Recognizing this difference helps you determine whether a move was driven by strong conviction or by slow accumulation. Before we talk about trading strategies, let's quickly go through the settings so the tool behaves properly. Open the indicator settings panel. One of the main parameters controls swing detection length. This determines how sensitive the tool is when identifying swing highs and swing lows. A smaller value will produce more swings and more profiles. A larger value will filter out small movements and focus only on major swings. If you're trading shorter time frames, you may want a smaller setting so you can see more detailed swing activity. If you're analyzing higher time frames, a larger setting often works better. Choose the option that gives you the clearest structure without clutter. Now, before we get into the actual strategy, let me share something that changed how I trade. You can learn this setup perfectly, but if you're not at your screen when it triggers, you miss it. And that used to happen to me constantly. That's why I started automating strategies like this, back-tested setups that run whether I'm at my desk or not. These work across forex, futures, gold, and they even work at prop firms. If you want access to the exact strategies hundreds of traders are already using, check the first link in the description. Long setup. First, identify a completed downward swing with a visible volume profile. Look for the point of control or the value area within that swing. If price later returns to that region and begins to stabilize, it can act as support. Watch the candles closely. If you start seeing bullish candles rejecting the lower part of the value area, that suggests buyers are stepping back into the market. A common entry point is the first bullish candle closing above the value area or away from the POC. Your stop loss can be placed just below the value area low or the recent swing low. Targets can be the next swing high, the next major resistance level, or the value area of the next profile above. Short setup. For short trades, the process is reversed. Look for a completed upward swing with a visible profile. Identify the point of control and value area. If price returns to that region and begins to stall or reject it, that area may act as resistance. When bearish candles start closing away from the value area or below the POC, that can signal that sellers are regaining control. A common entry is the first bearish candle confirming rejection. Stops typically go above the value area, high, or above the recent swing high. Targets may include the next swing low or the value area of the next profile below. If you're a serious trader trying to get funded, you need more than a single tool. You need a full toolkit consisting of elite algos that catch the best moves while avoiding losses in sideways markets, proven strategies across multiple markets, whether forex, gold, or futures, with the risk management built in, and fully automated systems so you can trade without being at the screen all day. So if you'd like to stop burning your time and account testing random indicators and start using elite tools and automation like all these other traders, click the link below. Different markets may require slightly different settings. In forex, swing profiles often work very well because currency markets tend to respect volume structure during trending sessions. In crypto, price swings are often faster and more volatile, so smaller swing detection settings may help capture meaningful moves. In stocks, higher time frames tend to produce the most reliable profiles because institutional participation accumulates over longer periods. In gold, profiles often act as precise reaction zones due to the high liquidity in that market. Now, if you want to try this tool yourself, the indicator we've been using in this video is called Swing Profile, and it was created by Big Beluga. You can find it directly inside TradingView by searching for it in the indicators menu. Thanks for watching, and I'll see you in the next one.